Hello, class, and welcome to our 13th lecture series on financial accounting or principles of accounting. I'm your instructor, Jamal Haider. So today we are starting chapter 9, which is the liabilities. So the asset sides of the balance sheet we already covered. We talked about how how we account for cash, and then we talk about how we account for the account receivable, and then inventory, and then the plant assets, right? So today we'll talk about the liabilities. And what kind of liabilities? Current liabilities. So our first learning objective is account for current and contingent liabilities. Let's talk about this. So current liabilities. So these are the obligations within which are due in 1 year, whose life is up to 1 year or less than 1 year. Or if we have the accounting cycle or operating cycle, if the operating cycle is more than 1 year, then up to the operating cycle. So the idea is these liabilities should be fulfilled within the accounting period. If your accounting period is above the 1 year, then it should be between that accounting period or up to the accounting period. So normally every even the governments, even those the other parts of the world, different countries, the companies, they use benchmark as 1 year. So commonly we can say that the life of the current liabilities, they are less than or equal to 1 year, not more than 1 year. More than 1 year, and they become long-term liability. Okay, so there are two kinds of liabilities. One is called known amounts, and the other is called estimated amounts. So it means current liability with known amounts. Second, current liabilities with estimated amount, right? So let's explore number one, which is current liabilities of known amount. So current liabilities of known amount, as its name implies, that we exactly know that this much we have to pay. This is our liability, and after some time we have to pay the known amount or full-fledged amount. That's it. There is no ambiguity. So the categories of current liabilities with known amount, they are account payable, short-term notes payable, sales tax payable, accrued liabilities, payroll liabilities, unearned revenue, current portion of long-term debt. Understand, guys? So in all these categories, in all these account titles or current liabilities, the amount is, we know for sure, there is no ambiguity or there is no estimation. So let's explore number one, account payable. So it is the amount that owed for the product services purchased on account from supplier, right? So we did numerous number of exercises relating the, we purchase goods or supplies on account, and we did the entry, and we use the word account payable, right? So the common transaction is credit purchases of the inventory, right? So it means we basically purchase on credit using account payables. So like we discussed earlier as well, these are suppliers. Basically account payable are our suppliers. So there is also financial term which we want to measure the health of the company, and we measure it through accounts payable turnover. This is a finance concept, so don't be just confused here. Just for your information, accounts payable turnover is an important measure of liquidity, which means how fast we are paying our, or how many times we are paying our suppliers. So we are regularly purchasing on credit, and either we are paying 4 times a year, 5 times a year to the suppliers, or 2 times a year. So you purchased 5 times and you paid him 3 times. It means 2 times you didn't pay. You will pay next year. This is good or bad? This is obviously bad. Why? Because you are facing now liquidity. You don't have that cash. You have the ability to pay, but you don't have that cash right now. So we call this liquidity problem, right? So basically, this is a finance concept. If we are able to, have some finance courses together, financial account, advanced financial management or financial management, then over there I would be explaining further this concept in deep detail. But right now, since we are having discussion on how to account for current liabilities, especially accounts payable, so the emphasis here is just basic one. So just for you guys, just to understand that it measures the number of times a year a company is able to pay to its accounts payable or its supplier. That's it. So the turnover formula is purchases from the supplier divided by average account payable. And how we calculate the average account payable? Opening plus ending divided by 2. Previous year balance sheet, we pick up the accounts payable number, and this year balance sheet, we pick up the accounts payable number, we add it and divide it by 2. That's it. So this is just for finance. If you just don't want to read that one, so it's okay for you, because right now our focus is how we are account for how is the accounting treatment of account payable, not the financial treatment. Okay, so this is the inventory T account, and left hand side is called debit, right hand side is called credit. So left hand side, basically inventory is our assets increase, so increase in the asset going to be recorded on debit side. So its T account looks like here. So we have a beginning balance. If we purchase inventory would be increased. Increase means debit, so we'd be writing down on left side. And the right hand side is going to be, we are going to expense the inventory. It means if we sell those inventory, that cost of selling going to be our expense. So it decreases the inventory, so that's why it is on credit. So a journal look of inventory T account looks like that. On the left hand side, we are going to have our opening balance and purchases. The right hand side, on the credit side, is going to be having the expense, how much inventory is going to the income statement. And of course, the balance. So the normal balance of inventory would be a positive number because it's an asset. And assets always have some kind of debit balance. Okay, guys? So we just completed the accounts payable. So I'm going to be asking a concept checker from one of you guys. So kindly read this true false. Here we go. So let me read it as well. So those who are attending the online lecture, it's good for them. So purchasing merchandise inventory on account results in an account receivable. True false?
False.
False. Minsu? Junpyo? Sipaday?
Sir, I also think it's false.
False, false.
False. Chloe? Okay, it's false. Why? Because account receivables are our customers.
It's what, yeah, profits.
We purchase the merchandise from suppliers, and suppliers are called accounts payable, not the receivable, right? So
That's fair.
Right, guys? Okay. Now the other one is called short-term notes payable. So it can be long-term as well, but if question is silent, then notes payable generally are longer term, more than 1 year. If short term, then question will mention that this is short-term notes payable. What does it mean? It means we have to pay the money within 1 year or up to 1 year. We cannot extend it. So it's due in 1 year. So it is basically used to borrow cash or purchase assets. For example, you want to buy furnitures and you bought it furniture from the store and you write it down a notes payable on a business letter. You write it down. Okay, we have purchased 3 tables, 4 chairs, and the bill is like 15,000 RMB, and we are going to pay you after 3 months. The shopkeeper or the owner will say that, look, if I sell right now, I would receive 15,000 right now, and I would deposit that 15,000 to the bank, and I would earn 1% interest or 0.5% interest whatsoever. So if I am selling you on credit, so I deserve some kind of interest income as well. So this arrangement looks like a loan arrangement. So normally notes payable are drawn against some purchases, some assets, or if you need some cash right now, you can ask your other businesses partners, your friends, that you can just borrow the money. I'll pay you some interest as well, because if I borrow money from the bank, it may be a time consuming activity. Sorry guys, let me hear one more time. I just mistakenly press escape button. Oh, can you see that right now?